Hello everyone, Clifford Bennett, Chief Economist ACY Securities. I hope you're having a fabulous day. Very quick video update for you today. Really, it was about two things that I thought were there were three things I thought were very interesting about markets on the day, which give us an idea as to the future movement of stock markets, even perhaps over the next 24 hours. So, first thing, Christopher Waller, Federal Reserve member. He was very clear that he thought the current jobs market was at unsustainable levels and the Fed had to do something about bringing that market down, taking that pressure out of the jobs market, out of the employment scenario, so as to allow inflation to fall back. And he also made similar comments about the state of consumer behavior. So the Federal Reserve is actually very unhappy that we have a strong jobs market and a steadfast consumer, which, sounds very strange if you just set it out of the context. But the context, of course, is an inflation superstorm that's taken hold and the Fed is losing. I noticed I created that sort of analogy a little while back, and it's starting to get, not because of me, just in parallel, it's starting to become a terminology that other people are using as well, that there's a war between inflation and the Fed is losing. That's what I'm saying. Most people are writing articles about who's winning the war. Well, I think inflation's clearly winning the war. So we've had clear re-acceleration across every measure of inflation now. So producer prices, PCE, all re-accelerating on a monthly basis. The Fed is extremely concerned and has to do something about this. So it's going to continue to hike, as I've said, and I love this little phrase, spin of phrase, to the horizon and beyond. That's what Fed rate hikes are going to be doing. So another 4 to 8 Fed rate hikes. It could even go to a terminal rate of 7.5%, which has always been my risk scenario. My central scenario remains the 5.75 to 6.5% range, which I've had when every other economist was thinking the Fed would stop at 4%. So it's going a lot higher, and markets still are not really pricing this in. Now, the second point I want to make is that all the US big retailers in the US are singing from the same prayer book, or song sheet, whatever. And that is that retailers have stopped spending on discretionary luxury items and are really spending on food and the essentials. So this says sick economy. US economy is in dire straits. It had a slight bounce in January, but December was full of storms in the US. People didn't go out and spend. They did all that spending in January, which is why you have December down, January up so much. But that's not going to last because all of that aberration is going to work its way through. It might still be a little bit of it in the February numbers that we're seeing, but that is not the outlook for the rest of the year by any stretch of the imagination. Anyone who thought so, well, I guess they're going to be badly mistaken. Ta-da! Well, we can't be sure of being right? Well, we just give it our best shot. So the US is worried about the consumer's too strong. Inflation's re-accelerating. We've got to keep hiking. Bit of a panic going on at the Fed at the moment, I'm sure. Probably drinking vodkas more than the usual cup of tea. Vodka shots all round for the board meeting this FOMC. Now, on top of that, we've had this really interesting spike in US stocks on the day. But we didn't for most of the day. In fact, for the great majority of the day, the stock market was heavy, moving lower. And then suddenly in about 5 to 10 minutes, the US stock market had a bigger move to the upside, about that, than the surprise CPI, PCE, producer prices numbers had. You remember they were devastating real economic, meaty economic news? Well, the markets fell about that much on that news, but in the last 12 hours, we saw a 1 hour, 1.5 hour rally. That was actually because I was describing the first 5 minutes. Well, the 1.5 hour rally was more like that. So on virtually no new news, nothing of real relevance. So what's going on? And it's because 40% of the daily volume of the SP 500 is now one-day options trading and hedging. One-day options trading and hedging now makes up 40% of the daily S&P 500 turnover volume, and it used to be 2%. So things have changed. Now what happens is when that kind of activity generates an abstract move, you have all these momentum algorithms that kick in on the day to just keep buying as well, which kicks in more options, which kicks in more algorithms, which kicks in more sorry, did I make the point? Yes, I think I did. So we're getting these extreme swings in both directions on occasion. But often we're getting this bizarre swing to the upside, and it could be because of the economic data in the morning, everyone's bought puts. But as the day begins to close, everyone realizes, oh, the market's not falling enough, I need to get out of my puts, or I need to close my puts, or whatever, or maybe I need some calls to hedge my puts, and then you're getting this accelerated, very unusual. Like these market conditions, they've never existed before. They really haven't. So will they last? For the foreseeable future, it looks like they will. So if you do have a short-term trading strategy out there, you'll need to adjust for what I'm talking about here. So the three big things I thought on the day were: 1, the Fed is panicking. 2, consumers are actually not as strong as people think. The US economy is not as strong as people think. And 3, there's aberrant price action, which gives a deceivingly healthy look to the US equity market on the day. What does all that add up to? Huge vulnerability to the downside. So I'm not sure if the market's going to crash immediately again. Could have another couple of days of rally, but it already looked tired really just on that one-day spike on that sort of activity. And the fundamentals have nothing but deteriorated for the US economy because the Federal Reserve will continue to be hiking for as far as we can see. Therefore, I'm still a defensive player, as I have been since the first week of January, and that's gone extremely well. And we're still, even despite this year's rally, we're still doing well overall, and I still think the US stock market has further to fall, and I hope that helps your day. In fact, I hope that helps your whole 2023. Have a great day. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.